If you sign your next mortgage renewal based on rate and rate alone, there's a very real chance that you're walking into a $20,000 mistake. Not maybe, not worst case, normal case right now. Canada's biggest bank, they just admitted that they're in a full-on rate war, which sounds like good news on the surface until you realize what's actually happening behind the scenes. They're not trying to give you the best mortgage. What they're trying to do is keep you from leaving their institution. And the way that they do it, it's hidden in one line of your mortgage commitment almost nobody ever reads. Let's go. Let me start with what RBC actually said. Their article is titled RBC, Canada's mortgage lending giant admits that a rate war is being waged. The subheadline, in an urgent bid to preserve market share, banks are pulling out all of the stops. Let's read that again. An urgent bid, pulling out all the stops. This is Canada's biggest bank, and they're scared because real estate activity right now is down anywhere between 40 to 50% across most major markets. Fewer mortgages to compete for, so every bank, every credit union, every non-bank lender is fighting harder than they have in years. Now here's where it gets interesting. Number one, the bank pushing the hardest to keep you has the worst mortgage on the market. So RBC, they're the biggest mortgage lender in Canada, but on a standard RBC mortgage, it's shitty. You can only prepay 10% of the original balance per year, and that's the lowest of all the big banks. Scotia, it's almost always 20%. TD lets you double up your payments. BMO sits in the middle of that. RBC, in my opinion, is dead last on flexibility. So when you see RBC running ads pointing fingers at other banks, just know they're losing market share to those banks that they're shitting on. They're losing market share to mortgage brokers, and they're losing market share to the non-bank monoline lenders that give you better terms. A reality check here. If your bank is calling you right now with a rate that feels too good to be true, the rate is not a gift. It's a defense move. They're trying to keep you locked in on a mortgage with terms that protect them and their shareholders, not you. On to number two, the rate is never the real cost. The structure always is. Let me explain to you what I mean a bit further here. I had a client situation. It came across my plate recently, a $675,000 mortgage, big bank lender. The client took the lowest rate at his bank at the renewal. He saved about $2,100 in interest over the 24 months, and then his life changed, like everyone's does. He had to refi. The penalty to break that mortgage was over $23,000. Let me say that again. He chased $2,100 in rate advantage and then paid $23,000 to get out of it. His net loss, close to $21,000. Now here's why the penalty was that big. Big banks calculate their break penalty using something called an IRD, interest rate differential calculation. And they don't use the rate that they gave you on your mortgage commitment. They use some made up bullshit posted rate, a rate that's often 2 to 3% higher than the contract rate that you actually sign. Let me explain the math on this. A $675,000 mortgage, 3 years left on his 5-year term. If the lender uses contract rate to calculate the IRD, the penalty lands around $7,500. If they use the posted rate on that same mortgage, the penalty hits at $23,000. It's the same shitty mortgage, the same client, the same dates, 3 times the penalty. That's not a fucking fee. That's a punishment. And it's written right into the contract that you so gladly signed at renewal time. Let's flip it now. Same income, same mortgage size, same renewal date. Way different structure, completely different outcome. And the difference, it was never the rate. When I work with my clients, I always look at 3 things and always in this order: the product, the penalty, and the privileges. First, the product. Does it allow you to refinance? Can you port it if you move? Can I blend and extend if rates drop? Second, the penalty. How is that lender going to calculate the break fee if the client has to break? Posted or contract rate? Because that one detail can be the difference between a $7,000 penalty and a $23,000 penalty on the exact same mortgage, like across the board. Non-bank lenders like your First Nats, your MCAP, your Strive, they calculate using the contract rate. The big banks, They use that posted rate, and that math is always going to hurt you. Third, the privileges. How much can you prepay each year? Can you double up payments? Are there lump sum windows? Rate, it's one line of the conversation, but it's the smallest part of the cost. Let me make this real for you. Let's say we have the two homeowners, the same $800K mortgage, the same 20% down, the same $165,000 household income, same 5-year term, apples to apples. One person chooses the big bank because the rate's the lowest and they got offered Visa points. The other chooses a non-bank lender, slightly higher rate, but contract rate penalty calculation. Full prepayment privileges, flexibility built in. Year 3, both clients want to pull equity to renovate. Now, a reminder here, like 65% of mortgages in Canada, they always break in year 3. That's just stats. That's not me making it up. That's stats across the board. That big bank client, they get quoted a penalty to break that mortgage at over $20,000. They cancel the renovation that they wanted to do. The non-bank client breaks the mortgage for a penalty, probably under $7,000. They renovate the house, they add equity to the home, they build wealth. Now these people had the same income, the same house, the same starting point, but completely different 5 years. And the difference, it was never the rate. Now, number 3, your bank works for shareholders. I work for you. My only interest is making you money on your mortgage. This is one of the most things that I see Canadians never think about. Every employee at a bank, they're legally regulated to do what's in the best interest of their brand and their shareholders. That's their obligation. That's their job. A higher rate, it equals higher profit for them. Restrictive terms equal higher penalty revenue. A licensed mortgage broker like myself, I have a different obligation. I'm legally required to act in your best interest. It's called my fiduciary duty. That's the law. That's the regulator. That's how the industry is built. So when you walk into your bank for a renewal, you're sitting across from someone who only has one job, and it's to maximize their brand's shareholders' revenue. Not yours, not mine. Now let me give you a rule that you can use today. When you compare two mortgages and one has a slightly lower rate but restrictive terms, the break-even spread that you should be looking for that's probably bigger than most people think. A lot of articles that you read out there tell you need like a 15 basis point spread. I'd push that number closer to 30 basis points, 25 basis points. That's 0.25% to 0.3%. Anything less than that, and the flexibility is worth more than that rate every single time. Because let me tell you something, life happens and it will change. Jobs change. Marriages happen, they crumble. You might want to refinance. You might want to port. You might need to break the mortgage entirely and sell the place. The cost of being trapped is almost always bigger than the savings on a marginal rate discount. Here's what to do when your renewal letter shows up in the mail. For the love of God, don't sign it. Don't even respond to it on the same day. Take the offer and go see a mortgage broker. Come call me. Have it stress tested against your 5 or 6 other lenders out there. Look at the product, the penalty calculation, look at the privileges. Make sure it matches your life's goals for the next 3 to 5 years. Then make the decision based on the full picture, not the front page rate. If you have a renewal coming up in the next 12 months and you want to run your numbers properly, comment renewal below. I read these personally. I want to see where you guys are at, or just book a call through the link in my description. Here's the takeaway from this video today. There's a reason banks are panicking right now. And there's a reason the lenders gaining market share, they're not the ones with the lowest rates. They're the ones that offer the best products with the best structures. The monolines would be like Strive, First Nat, MCAP. Scotia and Manulife would be the big bank level. These are the lenders that built their business on terms that work for the client, not on penalty revenue, not on locking you in. When the article from RBC talks about pulling out all the stops, making magic happen, what they're really telling you is this: their model's broken. The client wins when there's a rate war, but only and only if the client knows what to look at when talking with their bank. I'd see a lot of people look at one number on a renewal letter and then just blindly sign it. That's how you end up with a $23,000 penalty, and that's how you end up paying $20,000 more on a mortgage that you didn't understand at signing. Most Canadians, if not all Canadians, they don't lose money on their mortgage because of the rate. They lose money because of the restrictions that they didn't see coming or the lack of strategy built in. you don't have a rate problem, you probably have a structure problem. And if you want help looking at your renewal and picking the right structure with the best product, book a strategy call below. No strings attached, no cost to you. And when you're done with this one, go watch my last video where I break down what's actually driving fixed and variable rates in Canada right now. I'll see you there.